Yes, sir. Sir, very, very, very happy morning to each and everyone. Sir, first of all, I'm wishing you all the very best for today's examination. Sir, in this examination time, we will be very quickly revising working capital management. My dear lovable students, in this chapter, working capital management, from the exam perspective, we'll be getting estimation of working capital. Estimation of working capital. It is very easy, man. First, understand what is working capital. Working capital is equal to current asset minus current liabilities. So, we are going to deal with the balance sheet item. In balance sheet, we all know that, my dear lovable students, we will be having fixed asset and we will be having current asset. And here we will be having current liability. Sir, if we are dealing only with the current assets and current liability, current asset minus current liability is called as working capital management. So, as a financial person, you have to manage the fixed asset. The management of fixed asset is called as capital budgeting, and management of current asset as reduced by the current liability is called as working capital management. So we are going to talk about working capital management. So join along with me. What is working capital? Which is nothing but current asset minus current liabilities. So management of working capital is about the management of the current assets and the current liability. So if how you are going to manage your current asset, how you are going to manage your current liability in a business, that's what basically the working capital. That is, sir, in a broad classification, current asset that meet management attention, such as datas. We have to take care of datas, whether we are getting the datas properly or not, whether we are able to recover the money from the datas or not. And the next one is inventory and the cash and advances like prepaid expenses, whether the prepaid expenses is perfectly paid, whether we are able to adjust it or not. All those management is called as working capital management. In the liability side, current liabilities are like payable creditors and other outstanding dues. Fantastic to the core. So why I have to manage the current assets and current liability? Because it will affect the liquidity. Someone is quickly coming and asking, creditor is coming and knocking the door and asking that, give me money, where I will go for the money. So I have to always keep the liquidity. And number two, it will affect the profitability, because if I am carrying lot of stock, lot of data which are unrealizable, then automatically my profitability will get affected. That's why this chapter is teaching us, saying that, my dear lovable students, it will affect both the liquidity and the profitability. So you have to be very, very careful with your current assets and current liabilities, right? So, my dear lovable students, sir, we are going to talk about the various approaches of the working capital investment. So, as a businessman, if I am starting a business with, for example, 100 crore, entire 100 crore I can't invest in plant and machinery. If with this entire 100 crore, if I buy a plant and machinery, with what I will make the production? So, there should be some fund should be allocated to the day-to-day activities of a concern or a business. Such activity, such allocation is called as working capital management. My dear lovable students, that allocation may be aggressive or conservative or moderate. So three ways in which I can allocate the capital. One is called as aggressive, other is called as conservative, and other is called as moderate. What is aggressive? Investment in working capital, current asset, is kept as minimum. For example, I will not keep so much of current asset. I will be keeping only less amount of current asset. That means I will be so much aggressive in a working capital policy. That is, entity hold lower level of inventory, follow strict credit policy, keep less cash balance. That is called as so much aggressive. Sir, generally we will have an understanding of a reverse opinion, right? Aggressive in the sense means keeping lot. No. We will be keeping only less amount with the current asset, less stock we will be holding. Once we make the credit sales, we will ask to quickly get the money. That is called as, my dear lovable students, aggressive policy. Number two is conservative policy. Investment in working capital is increased. That is, current asset is increased as compared to the aggressive policy. That is, entity maintain higher level of inventory, follow liberal credit policy, and keeps cash balance as high as to settle any current liability immediately. So if I am having less amount of current asset, that is called as aggressive. Sir, if I am having good amount of current assets, that is called as conservative, my dear lovable students. Sir, what is moderate? Under this approach, a balance between, sir, I will be keeping a balance between the risk and the return is maintained to gain more by using the fund in a very effective manner. So these are the three ways in which you can maintain the working capital. So I can have aggressive, or I can have average, or I can have conservative, my dear lovable students. So up to this much will be the fixed asset level. So I can have aggressive. Aggressive means not much I will be keeping. I will be keeping only less. Average means I will be keeping, sir, medium, and conservative means I will be having sufficient amount of current asset. So if you are keeping less current asset, aggressive, more current assets, conservative, in between, that is called as moderate. That's what the ways in which you can keep the current asset, my dear lovable students. Surely I have to estimate the working capital for every business, sir. Everyone should know. For example, if you are going for a tour, you should know how much is the daily expenses you are going to incur. In the same way, in a business, my dear lovable students, estimation of what capital, working capital, you have to estimate the working capital. Sir, what are the methods of estimating working capital? By way of operating cycle. By way of operating cycle means it is a working capital cycle indicate the length of time between the paying for material entering into the stock to realization from the sales to the finished goods. Because, sir, first the raw material will be supplied by the creditors, correct? Then that raw material has to be converted into WIP. Then that WIP has to be converted into finished goods. Then that finished goods has to be converted into debtors. Then that debtors has to be converted into cash. And this cash has to be paid back to the creditor who supplied the raw material. This is called as one cycle. So how much time I am taking in my business to convert the raw material into cash is what my working capital cycle. Comfortable, sir? So first there will be cash with me. Then raw material, labor, overhead, which we have already studied in the costing, which is direct material plus direct labor plus direct expenses will give the prime cost. By incurring all that, I will make the production, my dear lovable students. Then that, sir, will be converted into WIP. That WIP will be converted into finished goods. That finished goods has to be converted into debtors. And I have to collect money from the debtors. That is called as cash. This is called as operating cycle. This is called as operating cycle. So operating cycle is equal to, in the form of equation like this, we can express the operating cycle, which is nothing but, man, raw material storage period. Tell me, raw material storage period. That means after I purchase a raw material, how much time the raw material is with me is what raw material storage period. Now the raw material will be there in the stores, as we already discussed in the cost sheet, my dear lovable students, that there will be three places inside the organization. One is called as factory. Inside factory will be having stores. Inside the stores only we will keep the raw material, right? And that raw material will be sent to the factory for the purpose of production. So raw material storage period and WIP holding period plus finished goods storage period. So this basically represent the factory, my dear lovable students. So inside the factory we are having stores ledger control account, WIP ledger control account, finished goods ledger control account. This is what the holding period. How many days you are keeping the raw material? How many days you are taking to convert the raw material into WIP? How many days you are keeping the finished goods inside the factory? And this has to be converted into debtors. That's what receivable or debtors collection period. Minus, my dear lovable students, creditors, credit period allowed by the supplier is the one working capital. So just think, sir, very easy, sir. First raw material will be there. Raw material storage period plus WIP holding period plus finished goods storage period, sir, plus debtors collection period minus creditors payment period is equal to working capital cycle. Are you all really with me what I am talking to you? Now, how I have to calculate the raw material storage period? Very easy. What is the average stock of raw material divided by average cost of raw material consumption per day? How will be calculating? Sir, average stock of raw material. Just think, man. Average stock of raw material. Just let me ask you one question to you. For example, if you are having 10,000 rupees in your hand now, in your pocket 10,000 rupees are there, and daily you need 1,000 rupees for your expenses. You tell me for how many days you are having cash in hand? 10 days, correct? The same way only, material storage period means what is the average stock of raw material? How much average stock I am having per day? What is the average cost of raw material consumption per day? This is what number one. Number two, WIP holding period. So I'm going to calculate the WIP. No, sir, average cash balance, how much you are having? Total cash in hand divided by expenses per day. This example you keep in mind. Then the average WIP, my dear lovable students, divided by average cost of production per day. Easy. Sir, finished goods storage period is nothing but, sir, average stock of what goods? Finished goods divided by average cost of goods sold per day. Easy, sir. Sir, receivable debtors collection period is equal to average receivable divided by average credit sales per day. Getting it, sir? And credit period allowed by the creditors is equal to average payable divided by average credit purchases per day. So, very quick, sir, my dear lovable students, the concept is nothing but this. I am looking into the storage period. How many days I am holding the raw material, which is nothing but what is the average stock of raw material I am having. What is average stock of raw material? Opening stock of raw material plus closing stock of raw material divided by 2. Very simple. In the cost sheet itself, we have studied. I taught you in the cost sheet that, sir, opening stock of raw material plus purchases of raw material minus closing stock of raw material is what raw material consumed, right, sir? Minus closing stock of raw material, you will be getting the raw material consumed, right, sir? This is a raw material consumed total for a particular year. So I want the raw material consumed per day means nothing but raw material consumed divided by 365. So you will be getting what is the raw material consumed per day. Fantastic to the core. I'll be adding opening stock of raw material plus closing stock of raw material divided by 2 average stock of raw material. So this much average stock of raw material I'm having, and this is the consumption per day. Very simple. Sir, one example for working capital cycle, 10 rupees I am with me, 10,000 rupees I am with me. Every day I am going to spend 1,000 rupees means I am going to hold that for 10 days the same way. Average stock of raw material divided by average consumption per day. Tell me for WIP, average WIP inventory divided by average cost per day. Then tell me for finished goods, man, average stock of finished goods divided by average COGS per day. Tell me for, sir, debtors collection period, average receivable divided by average credit sales per day. Tell me for creditors, average payable divided by, my dear lovable students, average credit purchases per day. Sir, simple, my dear lovable students, estimation of amount of different components of current assets and current liabilities. We are going into the estimation of working capital. This is a very important topic for today's examination. Estimation of working capital. What is working capital, my dear lovable students? Which is nothing but current asset minus current liability. What and all comprises of current asset? These are the items comprises of current asset. Number one is inventory, my dear lovable students. Current assets means what? Raw material will be there, right, sir? Inventory, raw material will be there. This raw material has to be converted into what? WIP. This WIP will become what? Finished goods. This finished goods will become what? Debtors. And sir, receivable, trade debtors. Sometimes this receivable may comprises of debtors will be there, my dear lovable students. Sometimes they may give the bills receivable, right, sir? And minimum what balance? Cash balance. This is called as gross working capital. Very simple items of the current asset. Tell me, raw material will be there. It will become WIP. It will become finished goods. That's it. Finished goods will become debtors. Debtors may give us bills receivable. And we have to hold minimum cash balance. How to estimate each and every item one by one by one? No, nothing. Sir, raw material inventory. You tell me, in your home, you have to keep the rice. Rice is the, sir, we have to manufacture what, man? Food. Food means what? We have to cook the rice. Sir, it's based upon how much rice you will carry in your home. It's based upon your consumption. If you are going to consume daily 2 kg, based upon that only you will be keeping the rice. So, estimated production unit. My dear lovable students, how many units you are going to produce? So, how many finished goods you are going to produce? Based on that only raw material consumption will be there. So, estimated production unit divided by either 12 months or 365 days. Then you will be getting how much is the, sir, per month production. For example, annual production is equal to 12,000, my dear lovable students. Divided by 12 means every month you are going to manufacture 1,000 units of finished goods. Comfortable? Into what is the purchase price per day? That's what estimated cost per unit. What is the purchase cost per day? Into average raw material storage period. For how much month you wish to, sir, hold the raw material? You want to keep for 2 months consumption? Then, my dear lovable students, you can keep for 2 months. That's it. Fantastic, my dear lovable students. So, what is the formula? Think of it. How much raw material I have to keep it as stock is based upon how much I am going to produce. Because based upon in order to manufacture my finished goods only, I need the raw material. So, estimated production of what? Finished goods. Either it has to be expressed divided by 12 months or 365 days into estimated cost per unit into average raw material storage period. Now coming to WIP, man. Again, the WIP is based upon the finished product. So estimated production or units divided by either 12 months or 365 days. That means you will get how much number of units you are going to produce into estimated WIP cost per unit. What is WIP cost per unit, my dear? This will comprise of material, labor and overhead. We already discussed in the process costing that material will be generally 100%, labor will be 50 and overhead may be 50, or it depends upon the percentage of completion. Are you all really with me? So estimated WIP cost per unit into average WIP holding period. For how many years or how many months WIP you want to hold it as stock. So very simple. So what is the formula for the raw material? Estimated production divided by 12 months or 365 into estimated cost per unit into average material cost. Fantastic to the core. Their estimated production divided by 12 months or 365 into estimated WIP cost per unit into average WIP holding period. Coming to the finished goods, my dear lovable students, estimated production divided by 12 months or 365, you will be getting the number of units into estimated cost of production per unit. Estimated cost of production is, my dear lovable students, which is nothing but material, labor and overhead. Everything would have been completed at how much percentage? 100% degree of completion will be there into average storage period. For how much months finished goods you want to store? You want to store for 2 months, so into 2. You want to, sir, hold it for 5 months, into 5. That's it. Fantastic to the core. Coming to the debtors, man, next element. So we have estimated the raw material, WIP and also the finished goods. When you are estimating the raw material, the relevant cost is only purchase cost. When you are estimating the WIP, the relevant cost is material, labor, overhead, but 100% completion would not have happened. We have to think the process costing. That's it. When you are estimating the receivable, my dear lovable students, when you are estimating the finished goods, sir, you have to think the cost sheet. Generally, the finished goods will be valued at the cost of production. Are you all really with me? Fantastic to the core. Coming to the receivable, man, estimated credit sales. This is not production. This is not production, because production is related with the stock, raw material, WIP and finished goods. But here it is estimated credit sales, my dear lovable students. How many units you have sold, you are going to sell it as credit sales, divided by either 12 months or 365 months into cost of sales, excluding depreciation. Because depreciation is not a cash item, it's a non-cash item. In that cost of sales, linked with the cost sheet, my dear lovable students, sir, you will be having fixed costs. Because we know that direct material plus direct labor plus direct expenses will give the prime cost, correct? Add factory overhead. Inside this factory overhead, we will be having depreciation. Depreciation is a non-cash item, my dear lovable students. That should not be included when you are valuing the data. Fantastic to the core. So into average collection period, we already studied that how to find out the average collection period, which is nothing but the average data divided by, sir, what is the credit sales per day? You will get the average collection period. Super, sir. Cash and cash equivalent, generally, which is given in the question. Minimum decide cash and bank balance to be maintained. Trade payable, creditors, sir, you tell me, debtors is related with the credit sales. So the creditors is related with the estimated what purchases, credit purchases, divided either by the 12 months. This is annual credit purchases divided by the 12 months will give you the monthly credit purchases, or divided by 365 per day into credit period allowed by the supplier. In credit period allowed by the supplier. Why? Because this we are not going to make anything, my dear lovable students. We are not going to manufacture. Debtors means we have to manufacture and we have to give it to the debtors. So we have to take the cost of sales excluding depreciation. But we are just going to purchase from the creditors. So into credit period allowed by the supplier. With regard to direct wages, very simple, estimated labor hours. How much number of hours that they are going to manufacture into wage rate per hour, my dear lovable students, divided by 12 months or 365 days. So we will be getting what is a monthly labor cost into average time lag in the payment of wages. Whether we are going to pay in delay of half a month or 1 month. I hope that, I believe that whenever I am saying whatever questions you have solved is striking your head. Then with regard to overhead, the same, estimated overhead for the entire year divided by either 12 months or 365 into average time lag in payment of overhead. So number of days in year may be taken as 365 or 360 as per the given in the question. So if you are estimating everything, you will be getting raw material. Raw material is nothing but annual production divided by 12 months into what is the purchase price into how much period of raw material you want to keep it as stock. Fantastic. WIP is nothing but average finished goods divided by 12 months or 360 or 365 as the case may be into WIP cost per unit into how much period WIP unit you want to hold. It's fantastic to the core. Sir, finished goods is nothing but annual production divided by 12 or 365 or 360 into what is the finished goods cost per unit into what is the finished goods holding period. With regard to receivable debtor, you have to think that total credit sales for the year divided by 365 or 12 or 360 into, my dear lovable students, sir, what is the cost of sales per unit excluding depreciation. If you are following cash cost approach, if you are following total approach, you have to include the depreciation also. Fantastic to the core. Minimum cash balance will be given in the question. Trade payable is connected with the credit purchases, man. Bills payable, just they will be given in the question. Wages payable is estimated labor hours into rate per hour. You will be getting the total divided by 12 or 365 or 360, my dear lovable students. Into my dear lovable students, what is the time lag? You have to multiply with the time lag. Fine. Payment for overhead, and always will be adding some safety margin, which will be given in the question, either 10% or 15%. You will be getting net working capital. One of the 5-mark estimated question is estimation of working capital. Go and crack the estimation of working capital. I believe that you are able to quickly recall the estimation of working capital in a better way, my dear lovable students. The next one is cash management. How to manage the cash management. Next, the very important component is one of the important component of the current asset is cash management. We'll be having for management of cash. We may end up with cash surplus or we may end up with cash deficit. So we have to go and take the bank overdraft, right, sir? So consideration in need for the cash is what is a transaction need, how much we need for cash, then speculative need and precautionary need. So when you are fixing a cash in hand, these 3 things you should keep in mind. Number 1 is how much is transaction need, speculation need, and also precautionary need. What are the cash flow budgeting? Receipts and payments method. You can follow either receipts and payments method. Receipts and payments method means expected receipts and payments are considered. Cash inflow or outflow of all functional budget, including capital budget, are all considered. Whatever the total cash inflow, total cash outflow, that is working capital receipt I will consider. Capital budgeting receipt I will consider. Everything I will consider. This is called as receipts and payments method. Adjusted income method means annual cash flow are adjusted by adjusting the sales revenue. And cost figures for delay in receipts and payments, that is changes in debtors, creditor, and eliminating non-cash items and all. Depreciation and all, why I have to consider for cash budget? So I will be taking only the relevant cash flows. That is called as adjusted income method. And adjusted balance sheet method means items of balance sheet that are predicted by expressing each type of asset except cash and bank balance. All the other item I will be predicting, like raw material, WIP, finished goods, debtors, creditors, and I will keep the cash and bank balance as the balancing figure, and I will feel that that's what the adjusted balance method. So we are having 2 models, man. William J. Baumol's economic order quantity model. We all know that EOQ. EOQ is equal to root of 2AB divided by C. The same formula here also, root of 2 UPS, which is nothing but C stands for optimum cash balance. How much cash balance we have to keep? That is the optimum cash balance, man. U. Sir, A means annual cash disbursement. How much is the annual there? We will call it as annual demand. Sir, fixed cost per transaction. In order to do every transaction, what is the fixed cost? And opportunity cost per annum per rupee, which is nothing but what we have studied in EOQ, root of 2AB divided by C. There 2 stands for annual requirement. Here A stands for, which is nothing but, man, annual cash disbursement. B stands for fixed cost per transaction. C stands for opportunity cost per unit per annum. This is what Baumol. Sir, here we have to see the economic way. At that economic way, we can keep the optimum cash balance as per this. Fine, man. Miller or cash model, sir, you can have either the 3 limits are there, either upper control limit, return point, or lower control limit. These are the 2 models, man. I'm quickly moving into the very important next topic, which is called as receivable management. Today, an expected question for examination, management of receivable management. That is, how much should be the credit policy I should be giving is what the question, my dear. So what you have to find out is, you have to take the expected profit. Listen very carefully, very important area. For example, first you have to take the credit sales, because for debtor, I am going to fix whether it is 30 days or 40 days or 50 days. Very important topic. Take the credit days. So already present policy would have been given in the question. They will say that proposed policy 1, proposed policy 2, and proposed policy number 3. Right. Total cash other than bad debts and what? Cash discount. Total cost other than bad debts and the cash discount. You have to reduce one by one. Right, sir? One is variable cost. Surely, in order to make the credit sales, I have to make the production. So production cost is a variable cost I have to take, and fixed cost is also a cost associated. Are you all really with me? These are the direct costs related to the credit sale. Direct costs related to the credit sale. So take the credit sale. In order to make the credit sale, I have to incur the variable cost and fixed cost, minus it. Fantastic to the core. So what I will be getting? Sales minus variable cost, contribution minus fixed cost, profit. Just marginal costing technique. The variable cost is nothing but cost of production, and fixed cost is nothing but fixed cost. So from the credit sales, reduce the variable cost and the fixed cost, you will be getting the profit. From the profit, now reduce the expenses relating to debtor, exclusive expenses like bad debt. Then number 2 is what? Cash discount. So you will be getting expected net profit before tax. From that net profit before tax, pay the tax. You will be getting expected profit after tax. Now, You have to reduce, sir, opportunity cost of investment receivable locked up in the collection period. Sir, if I'm investing in debtor, my money is what blocked in the debtor. So I am having some opportunity cost. So that cost also has to be reduced. You will get the net benefit. And in that, which is having more net benefit, you have to choose it. So what we are going to do in examination, we are going to take the credit sales. From that direct expense such as variable cost and fixed cost, we are going to reduce it. We'll be getting the net profit. From that directly related debtors cost like bad debts, cash discount, we are going to reduce it. You'll be getting the expected net profit before tax. After paying the tax, we'll be getting the PAT. Then we are going to reduce the opportunity cost. Why, sir? After payment of tax, you are reducing the opportunity cost, because opportunity cost will not be debited to the P&L account. It is a notional expenses which we are considering only for the purpose of decision making, not for the purpose of tax. That's why after payment of tax, reducing the opportunity cost. I hope that you are able to appreciate or understand. The same thing can be evaluated through incremental approach also. Sir, what is incremental approach? I will be checking that. Sir, this is the present policy. No, more than this, what is the additional sale I am having in the proposed policy 1? Sir, as compared to proposed policy 1, what is the incremental in proposed policy number 2? So this is what incremental. Comparing with the present with the policy 1, present with the policy 2, present with the policy 3. So incremental credit sales. Everywhere you add one word called as incremental credit sale. Less incremental cost of credit sale. Sir, that is variable cost and fixed cost. You will be getting the incremental bad debt loss, incremental cash discount, incremental expected profit, less tax. You will be getting incremental expected profit after tax. Are you all really with me? Then you have to compare the cost of sales will be there, variable cost, collection period will be there, investment in receivable will be there, either 360 or 365 days, incremental investment in receivable. Then you have to find out the required rate of return, required rate of incremental investment. You'll be getting the incremental net benefit. That means instead of analyzing one by one separately, you have to see what is better, which one is why first one is better than the present one. Like that, improvement or the increase will be taking. This is called as, sir, incremental. And financing also receivable, this is pledging and factoring and all theory, my dear lovable students. This, sir, no need to take care of it. Now, the last sir, area, important area from this is statement showing the evaluation of the factor proposal. For example, I am making credit sales. Sir, I am very bad at collection from the debtors. So what I am doing is, I am just giving the things to a person called as factor. Can I give it or not is the question. So what I have to check, if I am collecting the money from the debtors, I am incurring a cost. But if I am giving to that to an agency that is called as factor, whether I will be having net benefit or not. That's it. So annual saving, benefit or taking factoring service. What are the annual savings? Number one, cost of credit administration saved. If I am giving to an agent, I don't want to scratch my head, right? So that cost can be saved. The bad debts avoided, because entire bad debt will be taken care by that agency. If 100 rupees I'm selling, I'll be getting 100 rupees. So that is a benefit for me, savings for me. Interest saved due to reduction in the average collection period. If I am collecting, my dear lovable students, I'll be getting money from debtors only 90 days. But if I am giving to agency, the very next day I'm getting the money. 30 days I'm getting the money. So interest can be saved. These are the three savings. What are three savings, man? Administration money can be saved. Bad debt can be saved. Interest can be saved. These are my benefit, total benefit I have earned. But sir, that NSR factory is not my mamu. I have to pay some amount to that guy, right, sir? So I have to incur factoring commission, my dear lovable students. That is an expense to me. And number two is interest charged by the factor on advance. Sir, actually, that factor will be getting that money after 90 days only. But like a bank is financing money to me, so he will be charging interest. So that is an expense to me. And amount available for advance, balance only, man. Amount available for advance or annual credit sales minus factoring commission minus factory reserve into collection period, rate of interest, man. So I will be getting the total. So one simple thing, if I am not able to recover the money from the debtor, my dear lovable students, I can give the management to a factor. Then I can save the administration cost, I can save the bad debt, I can save the interest. Sir, but sir, I have to incur the factoring commission. And since he is paying the money in well in advance, my dear lovable students, he will be charging some interest. So that interest I have to calculate, and it's an expense to me. And the same thing, my dear lovable students, you can find out the net benefit. If the net benefit is positive, go with the factor. If net benefit is negative, don't go with the factor. That's what the discussion is all about, my dear lovable students. These are the max to max, sir, things you'll be getting. Sir, now in the last minute of your preparation, you can prepare for estimation of working capital management, point number one. And number two is debtors management and the factor. Thus, from this three topic, if you see three questions, that itself is more than for examination. I am wishing you, my dear lovable students, all the very best for today's examination. Proceed today's examination like anything, my dear lovable students.